And word up, we're seeing the market change. So if you've not seen it in your market, in your area, we're seeing it in our market, in our area. We've seen the first level out and actually dip in rents within the last year. So heads up, be prepared, know your market, know your trends, know what's going on. If you're not involved with a real estate investment group, actually find one absolutely as quickly as possible. COVID's out, so you can meet people in person. Network, network, network. Get coaching, people who can show you, who've done what you want to do, show you how you've done it. And then just be accountable and show up every day. Hey, what's up, all my real estate peeps? This is Brian Lucier with another episode of the Why Not Real Estate Podcast, Golden Nuggets. In the Golden Nuggets, we usually take a tip, a topic, or a technique, and we unpack it, give you some insight on one aspect of the rental market and what's going on, and hopefully you can use that to better enhance your business, and hopefully we can add value to your operations. So this is a series that we're doing off of our executive summary that we just put out for fall 2024. And on this section, we're going to talk about cash flow versus appreciation and a hybrid model somewhere in between. And we're based out of the Massachusetts area for this report that we did. But the information that you can use here with barrier entry will work in any market that you're in. If you're in a metro in the Midwest, or you're in California, we do some work out in California as well. Our offices are in the Boston area and the Los Angeles area, and hey, here in Aruba, why not, right? Why not? So I want to talk a little bit about this, and first I want to talk about the three types of strategies for investing. And then I want to talk about the concentric overview of a metro area and where you can kind of gauge these areas. And then a little bit about personal strategies. And then I'll wrap it up with some forced appreciation on how you could make your properties actually more valuable. And we have other videos that will explain some tips and tactics, due diligence and stuff like that, that you can do a forced appreciation or a value add deal. But I'm not going to go too deep into that. I more want to go around this bullseye market idea and give you the different strategies inside of it. So first is appreciation strategy. And an appreciation strategy is an investor who's not so much concerned about the cash flow of the property, but they want to buy a property in an up and coming market and see that the value of that property will go up. This works really good with a BRRRR method, which is a buy, rehab, renovate, rinse, rent, repeat, refi, all of that, all those R's. But anyways, you buy the property, renovate it, refinance it, rent it, and repeat, and you take that cash out and do it again. So that really works well with an appreciation strategy, or if you're like flipping multifamilies for appreciation. But you got to be in the right market to do that. So we'll kind of peel back the curtain a little bit in a couple of minutes and tell you where we think you would find appreciation. And then your cash flow strategy, we did a video just a little while ago on the numbers where you got to look at your income, you got to look at your expenses. Is there enough left over to pay all the bills and put some extra in your pocket? Really simple concept, that's cash flow, right? If you have enough properties producing healthy cash flow, then like franchises, if you had enough of this type of property, you could potentially have enough cash flow to retire and do whatever you want in your life. And then somewhere in between in the market, what we call a hybrid strategy, which is appreciation and cash flow. You get a little bit of both worlds there. So I'll peel back this a little bit more as I start to talk about my theory of the concentric rings. So in the Boston market, you've got the Atlantic Ocean, you've got Boston, and then you've got everything west. So the Atlantic Ocean is a barrier to entry because you can't rent property in water. I mean, Somebody will probably figure out a way to do that eventually, but right now, you can't drive into the water and rent there. That just doesn't make sense, right? So you can only go up to the shore, and that is going to be your most expensive property, just like what we're looking at here. Yeah, this was a lot of our portfolio sold to get here, but we did that. So your coastline or your barrier to entry in Massachusetts is the water. Now, if you're in another area of the country, this works, because instead of having half of a bullseye, you have the whole bullseye. So if you're in Metro Town, USA, and here's your center, then you have your next center out and your next center out. And as you go further out, the rents are cheaper, the properties are cheaper, the commutes are longer, and your appreciation will be less as you go further out, but your cash flow margins will be higher as you go further out. On the inside of that bullseye, you'll see the greatest and fastest volatility in appreciation, but you're not going to see the margins in cash flow as much. You may, right? But that depends on your market, and all markets are different, and all markets are local, depending on your market and where you are. Now, somewhere in between the metro area where you have the highest rents, the highest purchase price, contractors show up and they like to charge you double or triple because you're in a different zip code. Whereas if you got to travel 2 hours out into the sticks, they know they're not going to get Boston or metropolitan prices for the same labor. And it's all relative. Your contractor and your repairs are going to be cheaper out in that area. So are your income and your expenses. So it's all relative. So in the middle of the bullseye, you've got your highest prices, your highest expenses. But that's where you're going to see your appreciation on your deal. So if you're going to flip, or if the market's going up and you know what's going on in the market, that's where you're going to see a quick turn on your investment and make some money. Now, we talked a little bit about the suburbs, the outer urban areas around the metro areas. These are those nice areas where families can grow up. You'll have nice school systems. In Massachusetts, there's a lot of lakes and ponds and trails and bike trails and really good quality of living out in the suburbs. You're not going to get the highest rents, and you're going to pay more for your commute because to get a higher paying job, you have to go into the city. So this is where it works in your metro areas outside of Boston. I would say this in anyone who's looking in another market. See if you can get the news feed for the traffic reports first thing in the morning, because that's where you're going to see where the heavy traffic is coming from. And that's going to show you the desirable areas around the metro center where people want to live. If in your target, in your market report for the traffic, if they're coming from west to east, then that west side of the metro is desirable. If they're coming from east to west, then the east side is desirable. Same north to south. Wherever you're going to see those heavier traffic trends, there's something about that area where people are commuting from, which is making it desirable. Maybe it's affordable, maybe there's parks, maybe there's great schools. You have to look into your market and find out what's driving that indicator. So here we are, back to our bullseye. The hot appreciation is in the center. The hot cash flow is on the outside. And somewhere in that middle strip in between, that's your hybrid zone where you're going to be able to reap the benefits of both. You'll have higher margins on cash flow than you would in the metro area, but you'd have higher cash flow margins. You'd also have higher appreciation margins than your suburb areas, but then the flip is true. You'll have lower rents than your metro areas, and you'll have lower appreciation than your metro areas. So you'll outperform the suburbs, you'll underperform the metro areas, but that mix might just be right for you. It's like the Goldilocks right? This porridge is too cold, this one's too hot, somewhere in the middle. That might work for you. So what type of an investor are you? What is your personal investor strategy and what's going to work best for you? 20 years ago, I was cash flow all day long. So I would buy in the suburbs, those urban areas. We would buy a lot of properties because we could afford them. They were affordable. I don't want to say they were cheap, but we could buy a lot of units for a little bit of money and see cash flows of about $500 a door. So at our heyday, I think we were around $15,000 a month in cash flow, which was plenty for us to live on and survive and run a business and do all that stuff we needed to do. But I was younger back then and I could handle more risk. So I could buy these cash flow properties that weren't going to appreciate as quickly, but we held some of these for 20 years and 18 properties that appreciated in 200 to $250,000. Yeah, we walked away with a nice heyday, but it took time. It took 20 years to see that appreciation in the suburbs. Now, there's market cycles, and no one can predict a market cycle. I would not suggest timing the market. Not a good idea. Just look at the market and see what's going on. And we have other videos coming up to talk about the market cycles. So your younger investor may be more attracted to a cash flow property. Your mid to older investor may want that quick turn, so they may be looking at appreciation. We've talked to people on the show who only buy in nice areas. They said they learn the errors of their ways. They don't want to buy those C or D properties anymore because they want appreciation. This would definitely work for your larger syndications because you're coming in, you're buying a property, a commercial note will amortize for 20, 30 years, but the term is going to be 5 to 10. So you'll need to get out of that property or refinance or restructure the debt on that property within 5 to 10 years. So buying in a market which will appreciate is a really good idea if that is your personal style. So there's different rings, there's different strategies in those rings, and there's different personal investing strategies for the different investors. I say this all the time. You could ask 10 different investors what their investing real estate strategy is, and get 12 different answers because everyone will look at a market differently and everyone is going to have some other risk factor involved in how they want to purchase. So your older investors may be looking for appreciation. Your younger investors will be okay with the risk of cash flow. And then somewhere in the middle, Brian Burke was really good. People ask him, are you a buy and hold? And he says he's a buy and watch. In that mid-market, that mid-concentric ring is interesting, right? If your numbers work and you hit your numbers, there's no reason to stay in the deal. If you are entering into a deal like a larger syndication and you're coming in and you've got your metrics and you've got your numbers, if your plan is 5 to 7 years to hit your numbers and then you're out, Brian was seeing this happen all the time. He was buying properties and within 2 to 3 years was hitting his number, and that was his exit. He was watching, he hit his numbers, there was no need to stay in longer. He hit his numbers and paid off investors and went to the next deal. So there it is, right? Now, one little cherry on top of all of this, and this will work in all three markets. In your appreciation market, absolutely. In your hybrid market, it will work. And then in your cash flow market, it will also work. But it's a longer play time. If you can force appreciation on the property, and there's all kinds of ways to do this. On larger properties, you can do dog parks, you can do clubhouses, vending machines, other ways to get revenue, laundry machines, coin op. Even on your smaller property, on a 3-unit, you may be able to recoup $3,000 to $4,000 a year. And if you run the numbers, if it's a 10 cap rate, $4,000, $40,000, you could raise the value of your property $40,000 just by collecting coin-operated income. Now, are there other things you can do? Absolutely. You can add amenities, you can add storage, and we talk about that in other videos. But these value add strategies added to your, well, first, what market are you going to buy in? Do you want appreciation, hybrid, or cash flow? And then within that market, what are the things that you can do in those markets for a value add to force the appreciation of that property? So this video, the multiples that you could unpack here, you could probably come up with 9 to 30 different variables of what you want to do in any given market. And again, you ask those 10 investors, you get a dozen different answers on how you might want to invest in those properties. So here, just to recap, we're looking at the bullseye of a metro, or in our market, in the Boston area, that barrier to entry, right? For us, it's an ocean. In your market, there may be other barriers to entry. You'll have to know those. There's no way I could explain all those markets. I'd have to be an expert, and I'm not. And don't let anybody tell them that they are an expert. But you should be an expert in your market and know it better than anyone. If somebody says a street, and if you're in D&C markets and you know that street, you know it's a D&C market. If you're D&C markets and somebody says a street, you don't know it, then it's not a D&C market. So you got to know that. And if it's the A and B, the same thing, right? You know the A and B markets. So again, your cash flow versus appreciation, your risk tolerance as an investor. Are you a younger investor? Do you have more time to recover? Do you've got 20 or 30 years left on this mortal coil that you have to plan strategy a little tighter, work for appreciation? Are you somewhere in the middle where you can do a hybrid strategy? So you can take any one of those three and 3 to the third power, 3 times 3 times 3, 9 times 3. There's 27 different strategies that you could work out of this video. So I'm hoping, and again, this is just one little chapter in the executive summary that we just sent out to all of our clients for the spring 2024 market. If I had been calling it fall, sorry about that. But spring 2024 market. So yeah, if you are interested in getting a copy of that, if you're in the New England area, happy to send that out. You can definitely use the information that's in there. There's 7 different markets that we operate in, and we track all those for the 5-year trends and then the 12-year trailing. And word up, we're seeing the market change. So if you've not seen it in your market, in your area, we're seeing it in our market, in our area. We've seen the first level out and actually dip in rents within the last year. So heads up. Be prepared, know your market, know your trends, know what's going on. If you're not involved with a real estate investment group, actually find one absolutely as quickly as possible. COVID's out, so you can meet people in person. Network, network, network. Get coaching, people who can show you, who've done what you want to do, show you how you've done it, and then just be accountable and show up every day. That'll get you where you want to be, and yeah, it definitely will get you where you want to be. And I'm not out of the game yet, but we'll talk about that in another video. So hopefully this added value to you, your operations, what you're trying to do as a real estate investor. This is Brian Lucier from the Why Not Real Estate Podcast, Golden Nugget, signing off, and we'll see you all on the next one.